know I love it.
What is up, and welcome back to How to Invest in Commercial Real Estate today. And we have a cool topic today because I think a lot of people here are frankly probably not invested in commercial real estate. Maybe this is your stop to get educated. Maybe this is your first resource, or maybe you're a first-time investor of ours. But I think a decent amount of people listening and watching probably have not bought a commercial real estate deal before. So we've got an interesting topic to help maybe avoid some risk on to go into that deal. But first, we wanted to take a minute and stop and talk about the Criterion building up in Owasso. It is finally open. We've got Keller Williams. We've got a medical spa, beauty farm. We've got a hair salon, Birch & Co. Our office is opening up. We finally have furniture in there. It's looking great. And most importantly, our co-working space is about to open. So if you are local, if you're Tulsa, Owasso, or anywhere on the north side of town, really, we have an amazing new co-working space with state-of-the-art stuff. It's all wireless, keyless entry. Everything is included, tons of cool packages, and you can get involved in that for $100 a month. So I know for me, when we started our business in Owasso, I needed an office space, right? And the cheapest thing I could find was $600 a month, and it had like this shag green carpet. It worked at the time, but that was just the office. I had to go and get Wi-Fi. That was $400 a month. I had to buy my own coffee. I had to do all these other things.
Probably.
My own printer, all of it. I didn't have a receptionist. Didn't have a place to have conferences. Didn't have a conference room. Had to buy my own furniture, right? At the co-working space, all of that is included.
Yep.
For $100 a month?
For $100 a month.
Sounds like a pretty good deal.
But wait, there's more. I'm just kidding. Anyway, as you can tell, I am super excited about the new co-working space in Owasso, and that is going to be up March 1st. So if you're in Owasso, stop by, check us out, the new Criterion building.
Do we have any type of referral plan that if people listening to the podcast tell someone and they come in and they're like, hey, I heard about it from so-and-so, they saw it on your podcast, do we give them anything?
Yeah. I'll give you $25.
Okay, $25.
Just DM the page. My man Aaron will get you taken care of.
Nice.
Done.
I know some people.
So topic. You don't get
any other money you want to give away live on the fly? I mean, just any other deals.
What I want is people, using the co-working space. That's what I want.
That is the deal. But anyway, back to real life. First real estate deal, right? Like we're listening to the deal to get educated, find out how to get involved. We're learning that this is a beneficial asset class or something you may be interested in. So how do we avoid risk on the first deal? The first one, you want to hit a homer, maybe. But practically, it's like, let's just get on first base. How do we just not mess this up? How do we not lose everyone's money? Like, how do I get in my first deal and not have it be an absolute disaster, right? So we came up with 5 reasons. 5 reasons that can eliminate. 5 ways. See, I did it again.
But let me take a step back. Why haven't people that want to get in commercial real estate, have they not purchased their first deal? And there may be a bunch of reasons, but I would say a big one is fear. Fear of losing money, fear of not knowing all the answers, and that fear holds them back from taking action and buying that first deal. So we came up with ways to reduce risk on your very first deal because we think it'll help combat that fear. That knowledge combats that fear, and it'll give them the confidence to move forward and finally get in the game. So,
yeah. Well, I think the first one is maybe buying something you think you can afford, right? Like buying the smaller deal, buying the deal that's been on the market forever, or buying the deal that's in a bad location, or buying the deal that's in a small market, right? Like you're going small. You're scared. You're dipping your toe in, but in a sense, we kind of need to jump in, right? Because a nice asset that's worth owning and pays out cash flow that's worth having is probably a bit more expensive than you're initially thinking.
So you're saying that's a fear that people have is they're worried about buying something really small, or
no, they're worried about buying something too big, and so they go to buy something small.
I see. Okay.
But in doing that, they sacrifice some of the fundamentals. Risk. And look, for a seasoned commercial real estate investor, they may be able to find a gem that's off the beaten path that nobody knows about. Mm-hmm. But that is inherently risky because of where it might be, or because there might, be some hair on the deal in some way. So what we're saying, encouraging them, is take a step up, buy a better quality asset for your first one. Yeah, it's going to feel like you're paying more, but it'll hold its value more. And in that, there's less risk.
Yeah, right.
Yeah, we need to build a track record. We need to have wins. And the idea of this whole episode is let's not mess it up.
Let's not mess that first one up.
Our money, right?
Right.
So you buy a great asset at first. It's going to be more expensive than the thing in like Sepulpa or maybe the middle of nowhere, wherever you live. It's going to be more expensive than that. You want traffic counts. You want people living by your retail center.
You want something that looks really nice.
Right. That's going to be more expensive than something that doesn't look really nice. So we just need to get that in our head. You don't need the most expensive thing. I'm not saying go to the best part of your submarket and try to buy the Whole Foods. Okay, that's not what I'm driving to. I'm just saying at some point we need some traffic counts. We need some people. We need some jobs. Focus on some fundamentals.
And so what someone might need to do is, instead of thinking, okay, well, I'm going to buy this by myself, I'm going to buy a better property. I'm going to get some people to invest with me, right? And that reduces the risk.
Yeah, don't worry about not affording it up front. Like, let's just, at some point you have to set a parameter. Like maybe we need to stay under $5 million. But if you're looking at a $2 million asset, let's expand that to maybe 4 or 5 and think of some other creative financing options like bringing on investors or bumping up your leverage or whatever. But that's kind of a separate topic.
Yeah.
Just generally speaking, buy an asset worth having.
Right.
It's not the cheapest asset that you can afford.
Okay.
Number 2. This is something we focus on a lot, and I think it's important, is we're not massive speculative deal people. We don't typically buy the empty building and go in with the strategy of the massive rehab and this massive lease up. That's typically not our general deal, right? Why?
Well, we like cash flow, and so we try to buy as many deals as we can that cash flow from day one. And that reduces your risk because we're not dependent day one of finding a tenant or filling a bunch of vacant space to make the deal profitable.
Yeah. So when you're buying a piece of real estate that doesn't produce any cash flow or doesn't have any tenants, you're having to try to underwrite what the cash flow could be, because at the end of the day, you don't really care about the inherent value of the real estate as long as it's in a good enough position to get you the cash flow you need. So you're trying to like backfill how many tenants you can get in there, what rent they're going to pay. And again, it's all speculative. You have no idea if you're going to get tenants or what they're going to pay at all, right? We're going and buying a retail center or any other building for that matter, and it is full of tenants that have maybe been there 5, 10, 20 plus years. They've ran that business in that location at that spot, being able to pay their rent, not get kicked out, and still make a living, right? It's a business worth owning. You can underwrite that. You can take that to the bank and get a loan on it. You can show your investors, hey, I've got a dozen tenants that have been here on average 10 years. We've got leases rolling, throughout the next 5 years of our holding period. All we need is a 3% rent increase. That knowledge is helping combat fear, like you said in the beginning. It's helping raise money from investors. It's helping secure your loan from your lender instead of you trying to tell a story about this empty piece of real estate that doesn't make any money. Nobody cares about your story, and it's way harder to do. And again, on the first deal, we're trying to not mess it up. We're trying to not lose our money.
Yeah. Well, the other thing is if you buy something speculative like that, it's going to take a lot of heavy lifting, right? And so now you're out doing all this heavy lifting after you've bought this thing, and that keeps you from going out and finding your second deal probably, right? Because you're working so hard to get it leased up, or maybe you have to do a lot of
rehab
on it or whatever.
Yeah, I would say that the least amount of unknowns is going to be the best for your first deal. And so like you say, you're trying to speculate on how long is it going to take me to fill a vacancy? How many tenants do I need, and what's the rent going to be when I do fill it, and how much is the TI that they're going to demand? The thing is, you don't know that for sure. So yeah, you may have a good idea, and even a more seasoned professional might have a even better idea, but it's still, you're adding unknown after unknown to your very first deal. And on your first one, you need to win because that'll keep you going. Yep. If you fail on your first deal, it may discourage you.
Yeah.
So that's a perfect segue because things are going to fail. Shit happens, life happens, right? So like in this next point, we need to have some extra cash. You don't go into this thing saying, okay, I'm buying $1 million property. I'm getting $800,000 in loan proceeds. I need $200,000 in cash. Like, no, dude, you need like $300,000 or $400,000 in cash.
Easily.
Something is going to happen. Your parking lot gets older. It's going to snow. It's going to tear it up. Your roof is going to leak. Your roof is going to get older. Your HVAC units will stop working eventually. You will need to replace those. Right. Your tenants are going to ask for money. They're going to ask for free rent. They may leave. You may have to pay somebody to get a new tenant in there. You may have to pay for the tenant improvements to get the new tenant in there, right? So like stuff is going to happen. That's not a failure. That doesn't mean the deal failed. If you didn't have the money, maybe that would be the end of the deal. Maybe that would fail the deal. But if you have the money, you're able to reposition the asset. You're able to pay for the new tenant. You're able to pay for the loss of rent. You're able to pay for the new roof. You're able to pay for the new parking lot because you said in the beginning, hey, I know something is going to happen. I need to be prepared. Please.
So we're saying just have some extra cash available.
A decent amount of extra cash on your first deal. You need to go in, and that will reduce the returns.
Yeah.
But once again, you don't. I wouldn't worry on your first commercial deal about maximizing returns. I would worry about ensuring the returns, whatever those are.
Don't mess it up. Don't lose your money.
Learn.
And so if you have to, let's say the deal will return 12% cash on cash, but you're going to have to raise extra money to be really safe and secure on this first one in case something goes wrong and it drops your returns to 8. Well, 8 on your first deal, if you can secure that kind of return, that's going to be just fine.
Yep.
And your asset's going up in value, so it's better than 8. The cash flow is 8. So make sure you have plenty of cash on that first one. A rule of thumb, let's try to give them a rule of thumb. If I'm buying $1 million, just to make it easy, $1 million deal, and I'm getting an 80% loan, that's $200,000 in equity that I need. I tend to, probably go with $25,000 to $40,000 in closing costs. Various things from the legal docs to the closing fees and title insurance. And then on $1 million property, I would probably go in with an extra $100,000 in reserve. Okay. Now that goes up. A $2 million deal, maybe it's not 200, maybe it's 150, 175. $3 million deal, maybe it's 200. $5 million deal, maybe it's 300.
So let's continue to break that down a little bit, because you're going to say $100,000 on $1 million deal, an extra 10%, some might say. But on $1 million deal, let's just maybe $100 a square foot, maybe you have 10,000 feet, right? So 10,000 feet of roofing right now is maybe $7 a foot, $70,000 gone. Now you don't even have enough money to replace your parking lot. So your $100,000 is guaranteed to be spent right there.
Yeah, but hopefully you're making sure that if it needs that stuff going in, you're going to reserve for that as well. This is an excess for the unknown, because this is your first deal and you're inexperienced. You may not know anything and everything that could go wrong. So let's set the roof and the parking lot aside, because if that needs replaced, you have to raise for that as well. This is for, someone rams the building with a truck when they're drunk, like we've had at some of our centers, or a tenant or two move out and you've got to re-tenant that space with brokerage fees and leasing commissions and
a
all
water
that.
leak or something you can't forecast.
Yeah, so that it's just for that stuff.
Yeah, just for everybody's reference, we'll overdub the clip of somebody smashing through our building in a U-Haul truck at 2 a.m.
Yeah.
But life happens, right? It took us 90 days to get the insurance check from that. We're still working with getting it repaired, getting the tenant happy. Stuff's going to happen. And that property pays out great cash flow. It's a good thing we had the cash to flow through repairs until we get the insurance money in. Anyway, I know at this point you're thinking, guys, I've listened to almost 100 of your episodes. I'm invested in several of your deals. I'm a pro in commercial real estate. I'm going to go buy my first one. I've read the books, Rich Dad, Poor Dad. I know what I'm doing. I'm going to manage it. I know what to do. You guys talk about lease renewals, camp caps. I'm a pro, but I'm telling you, I don't manage a lot of my deals for a reason. Your first deal, you should not manage.
Yeah. You're going to miss something if you try to manage it yourself, right?
No, don't manage your first one. You want to hire a third-party manager in the market that you're buying in, and you want to learn from them. And they may even miss something. There's just things that are going to come up. But the thing is, you won't know if you've missed it. And we just want to make sure that you don't get into a situation that you were trying to manage it, you missed it, you didn't do the CamRex right, things went, and you get behind the 8 ball and it ruins your first experience.
Yeah. Plus, that's not your job. Like Brian said earlier, your job is to go buy these deals and make sure they're paying out their scheduled cash flow. You set the property manager up with a budget and a tolerance, and they've got the cash to make decisions, maybe $2,000, $5,000, $7,000, $10,000, whatever parameters you set. They work on a fee that your tenants are probably already paying for. So yeah.
If you want to save that money, then take a year, learn what they do, learn the reports, get a good handle on it, and then maybe take it over in a year or 2 years.
Great idea.
But if the deal doesn't work without third-party management, you shouldn't be buying it as a beginner.
But if you're local and you don't like headaches, call Joel. He loves headaches, and he third-party property manages.
Yeah, we'll third-party manage it for you.
Yeah.
Boom. All right, next point, underwriting, right? Like we've got to look at this. We've got to figure out what the cash flow is. We're not buying an empty building, so there's tenants, there's leases, there's income. We need to be making I would say a 3-year budget at least of income and expenses off of the leases. A 3-year budget, 3 years of principal and interest payments, 3 years of what your expenses are, 3 years of your income, 3 years of your net cash flow to your investors, or at least what you hope it to be, any capital expenditures that you may spend. Excuse me. But
yeah. And so that you should know how to do all that before you're buying a multi-million-dollar commercial real estate deal. What we're saying is get help with that first deal underwriting. Mm-hmm. There are third parties that will help you do that underwriting to make sure you didn't miss anything. We can recommend some. You can also have your banker. If you, let's say you really know your lender well, as a buddy or something, then have them underwrite it and see if they can see anything, any risk points. But don't go in and just say, well, I'm the only one that's looked at this. And I watched all the classes and I read all the books, and I'm not going to miss anything on the underwriting. That sets you up for risk. You may get it right, but if you don't, you could lose money.
I think on my first deal, I'd like to study it, like you said, personally, come up with my own, then maybe get a third party, and then of course the bank's going to do it as well, right? And so I would feel a lot more comfortable if I had 3 independent people underwriting my first deal.
Yeah, and a lot of this stuff, it's not like you are doing it in a consecutive order right after another. You're doing it coterminously, right? Like you're underwriting the deal initially. You're saying, okay, this looks good. This passed the sniff test. I may go ahead and get this in contract. I may start inspecting it. But as soon as you get it in contract, one of those inspections is a third-party underwriting. Your lender is going to do it. Obviously, you're going to start to look for property managers. You send it to them. Hey, I've got this property under contract. Here's the due diligence materials. Here's what I'm thinking it should bring in. Does that jive? You know, you're going to have these conversations before you get to closing. You're not going to close on this thing without some sort of budget from somebody. Somebody's going to help, but just make sure it's sooner rather than later. Have those conversations.
Yep. Is that all the ones we had for today?
Nope. Last one. So we buy a lot of stuff out of market, but for your first deal, you should probably stay in your market.
Yeah.
You should probably stay local. You should probably have a good understanding of what area the town, what area of the town is doing, where the growth is going, where the new jobs are, where the main traffic corridors through your cities, where the suburbs are, where the city is. You know, you need to be able to pinpoint this and tell that story to yourself, to your investors, to your lender, to your property manager. It needs to be something you believe in. And going out of market, I think you said it before the show, you're just adding risk when you...
It's another layer of risk and another layer of expense because you've got to get there. And it takes time and money just to go view the asset and maybe view that market. And also, if you're going to buy in a market you don't live in, you're going to have to get advice on that market and how the property that you're looking at and where it is and how good it is and what school districts and traffic counts. Well, you're depending on another human now. So it just adds another layer of risk, even though they're probably telling you, what's accurate. If you can just buy in the market you live in, as long as that market is sufficient size. So if you live in a really small town, don't buy your first deal local. Go to a town that for retail, I like to have about 1 million people MSA, especially on your first one. So the city can be 500,000, but if it has a metro area of about 1 million people, that's probably a good sufficient size. Multifamily, you can go a little lower, maybe a couple 100,000 people, just because it's a more stable asset class. But a lot of these small towns, the winds, so to speak, can shift and change as far as population growth. They're maybe dependent on a factory or some other big business. And so the towns that were booming 100 years ago, we see them all the time. They're dead today. Right. And you don't want to be in a position where your market starts declining because it's just too small. Once markets get to a certain critical mass, they're going to grow, or they should theoretically continue to grow for decades.
Plus, the goal is to not mess it up, not lose your money. At the end of the day, if something happened, which something's going to happen, but it's just a matter of whether or not you were prepared and whether or not it took you down. But if something happened, do you want your first deal, your first one, all of your investors coming back to you? They're thinking, what are you thinking?
Yeah.
Why would you buy your first deal 500 miles away from you? Like, why would you do that?
You're going to have a hard time convincing investors on the second deal if you mess up the first one. So, and like Joel said, you're going to get discouraged probably.
And if you buy in a small, a small market, you may not have a buyer when you want to sell. Right. Because there's just the limited buyer pool for, let's say, Wagner here in Oklahoma, outside of Tulsa. It's not going to be easy to sell deals like that. So pick a good sized market that you either live in or are really close to.
All right. Well, I think that's helpful. On your first deal, you want to go big. You don't want to buy something empty. You want to have plenty of excess capital for reserves because something's going to happen. You're going to go in with a management team with you. They're going to help you underwrite it. Your lender is going to help you underwrite it. You're going to have this team of people helping you underwrite it, seeing the same things you do as far as free cash. And it's going to be local, guys. I mean, it makes sense for your first deal. Those 5 reasons should keep you, like if you're going into your first deal with those 5 things at the top of your mind.
Yeah, those things will reduce your risk. It's not going to be zero. Your risk isn't going to be zero, but it's going to be way lower if you follow some of the points that we're trying to convey to you.
Anyway, I think that is it for this week's episode of How to Invest in Commercial Real Estate. We will see you guys next week.